What about fiscal policies? Fiscal policies have really been quite dramatic. Here's some graphs. This is a graph from the latest OECD Economic Outlook that came out last week. You can see that up until 2007, deficits were running around 2 to 4% of GDP. If you look at these graphs, you can see the most amazing change in fiscal policy. In the UK, budget deficits of 13% of GDP. In the US, greater than 10% of GDP. These deficits are big and they're not projected to go away in the next few years. This is a massive absorption of private sector wealth into government coffers. A 10% of GDP fiscal deficit is a very, very large fiscal deficit, unprecedented since the Second World War in the US. What does it mean for debt? Well, it means that if you look at this chart of projections from the OECD for 2011 versus 2007, government debt in the US will be 100% of GDP. In Japan, 200% of GDP. Now, what does 100% of GDP government debt means? It means at an interest rate of 5%, you have to take 5% of the economy to pay the debt interest per year. Now, that's an amazingly large amount of revenue transfer that the governments in these economies are distorting their economies. What's happening on the trade front? Well, nothing except bad news. There's a tendency, as there was in the Great Depression, for countries to turn inward looking, to protect domestic industries. We're already doing that to protecting domestic financial industries. There's a movement to protect domestic manufacturing industries. What happens if there's a trade war? There's a paper published this week by the World Bank that I co-authored with Andy Stokel, where we looked at what happens if every country in the world increased tariffs just by 10%. And it is possible to raise tariffs by 10% without incurring the wrath of the WTO by various policies within the WTO rules. You probably can't see this chart, but just to give you an idea that the results of that paper show that by 2011, the change in GDP in the first column of every country for a global trade war is devastating. For some countries, let's take China, GDP falls by 4.3%. For Germany, GDP falls by 3.8%. This is not a big trade war, this is a small trade war, but this is how linked the economies of the world are today, that if we start putting up barriers, we can end up with some very significant economic slowdown. What's interesting, and you can't obviously digest all this material, but if you look across each column, it tells you what is the impact on each country on the left by a change in tariffs by the country across the top by itself. And what we find in this framework is that raising tariffs hurts yourself, which is the opposite to the populist view that raising tariffs protects yourself. It hurts yourself and it also hurts your neighbours. So if everybody does it together, everybody is in big trouble. Now, the reason tariffs hurt you is because in the global system we've developed, there's a lot of trade in capital goods. And if you put a tariff on capital imports, you increase the cost of capital, you reduce investment, you contract your economy. This is something to be avoided in the modern world. Now, before the crisis emerged, there was a lot of discussion of macroeconomic imbalances. And most people focused on one imbalance. There are actually two imbalances in the global economy. One imbalance was that global savings was in excess of global investment. That meant that real interest rates were remarkably low. That meant that corporations and individuals were investing in very, very risky activities in an attempt to generate a bit of yield on their investment. So the first distortion we faced was this large imbalance between savings and investment. Now, that's actually gotten worse during the financial crisis. Global investment has shrunk, global savings has risen, real interest rates around the world are historically low levels. This is a problem in terms of the nature of the recovery and the nature of investments that are being undertaken. The other imbalance, which is the one people are familiar with, were actually the current account imbalances. And these current account imbalances, a lot of people think about in terms of exports and imports, but I find it more useful to think of it in terms of savings versus investments. So those countries that saved more than they invested tended to run current account surpluses because those savings were going overseas. Those countries that invested more than they saved generally ran current account deficits and they were pulling in savings from overseas. So these imbalances showed up through current accounts and therefore through trade flows, and that led to a lot of political risk in terms of financing of capital flows as well as potential for accusations of mercantilist policies. What's the current status of the global imbalances? I don't know how well you can see this chart. It's from the OECD. But if you look, I can't point because I'm standing behind the screen. I can point down here. If you look at that chart, you'll see that below the line are the countries that are running big current account deficits, and the bluish line is the US. And then you see there are several other countries, including Australia, in the rest. These are the countries that are sucking in capital. But if you look above the line, you see China is the dark blue line. And then we have Japan, we have Germany, and then we have oil exporting countries above those. So you can see that there are several regions of the key exporters of capital, several regions are the key importers of capital. You can clearly see where the financial crisis occurred and these imbalances contracted. Now, in a very optimistic set of projections, you can see that the OECD is projecting that these imbalances are going to drift further apart again. And in my own work, suggests that this is going to be a much more rapid process. So these imbalances haven't gone away with the financial crisis, and these imbalances are likely to get worse before they get better. One of the reasons for these imbalances, and one of the reasons for the sort of structure of the world economy we see today, is the emergence of China and India. And this is a key set of issues that we as a nation in particular have to deal with. If you look at the scale of these countries, it's useful just to look at population first. And this chart shows you population in 1950, 2005 and 2050, where we're ranking countries in size. So you can see in 1950, China was the biggest country. It had about 5.6 billion people. Sorry, it had 500 million people, and that was 22% of the world population. Now, as we look at 2005, China now in 2005 has 1.3 billion people and is 20% of the world population. But as we move to 2050, there's a major demographic shift going on in China, and India overtakes China, the world's largest population, with 1.6 billion people. By 2050, the UN projects about 9.1 billion people in the world compared to about 6.7 today. So we have this major change going on in China and India. You also notice in 2050 that most of those countries in that column are emerging developing countries. We have Pakistan becoming the 4th most populous country in the world, Indonesia the 5th. There's a lot of economic, political issues associated with big shifts in population. What are the economic impacts of these big changes in the global economy? Well, first there's the scale effect. With these masses of population coming into the world economy, the economy is going to get bigger. There's going to be changes in the composition of production because these are very poor people who are doing agriculture, labour-intensive manufacturing, working through the development chain. That change in production has a very big impact on the global systems of production. But also there's a massive change in consumption. These populations, as they're moving through development, go from a very intensive, low nutrition diets into very high nutrition, high intake of beef, etc. This consumption change is really quite dramatic when you look at the scales involved. So we have this potential on the production side to see enormous shifts, and we've already seen them in the last decade, but on the consumption side to see equally impressive but very different structural shifts.